G'day everyone, welcome back to another update. Today we're looking at gold and silver. Now they're both still very bullish in terms of their trends, but do watch for that divergence on both charts. We'll go to those in a moment. First, make sure you hit that like and subscribe button to support the channel, that'd be greatly appreciated. In terms of the outlook for gold, first of all, in terms of a bull case, a US Fed under political pressure could drive gold prices as high as $5,000, supported by central bank accumulation and dislocation in traditional safe havens. The bear base case scenario, balanced demand could sustain prices around 3,700 by mid-2026, according to UBS. However, if global growth rebounds and geopolitical fears ease, Citi flags the possibility of a slide below $3,000 by late 2025 or early 2026. For silver prospects, benefiting from both investment flow and industrial demand, notably in green energy and manufacturing sectors, historically tends to outperform gold during recoveries, currently seen as an undervalued with a high gold-silver ratio, suggesting potential upside. Forecasts vary, but many point to silver pushing higher toward $46 by the end of the year, this year, 2025, if supply tightens and demand holds. So looking at gold first, on the weekly, we look at the trends. The price is well above the moving averages and still skyrocketing. Although I do notice we've got this bearish divergence on the CCI. This is a very long-term play, as you can see. Started back at the start of 2024 and still going. And it's actually gone further than when we had in our last update. So I'm going to raise that trend line. I'm going to readjust that target range as well. And you can see there, that's also CCI still dropping. So lower highs versus higher highs on the price. Now, let me just zoom in on that for a moment. So what we do now is we readjust this 23-38% target range. We get the 50 Fibonacci. Now, assuming it pulls back from there, and it's probably a bit too early to draw, because I'm going to have to probably readjust it next time as well. It looks like it's not going to drop anytime soon. So assuming it starts dropping from there, we're going to look at that 23-38% Fibonacci range as a minimum. It could just touch it and bounce, or it could fall right through. We can't really tell at this stage. But like I said, it's a bit too early to call it yet. As soon as it starts pulling back towards that moving average, then I'll probably definitely draw that target range. So it's a bit too early to call it yet. Anyway, we've still got a bearish divergence on the weekly, even though the price is still very bullish above the moving averages. On the daily, it's actually broken through this resistance up here at 34.51. And currently on the gold, there's no sign of a resistance, another resistance. So I'm going to delete that resistance until we see a resistance forming in the near term. Now also notice on the daily, we did have here on our last update a bearish divergence. So what's happened now is that CCI has gone higher than that previous high, which means that is no longer a divergence. So we're going to delete that bearish divergence on the daily. No divergence currently on the daily. So that's looking still very bullish at the moment on the daily price, on the daily chart. Now looking at the hourly, we always look at the hourly for any minor moves, and as you can see there, we had a bearish divergence on our last update. We drew a target, hasn't actually quite reached that. It's missed those two targets, and what it's done, the price has kept going. And this is why I don't trade the divergence, because you can't tell exactly where it's going to fall down, fall to the downside. We need to see it break like it did here. It came close to breaking to the downside. When it broke in the moving averages, the band started bending to the downside. You can see there, it constricted there, then it started turning down, then it adjusted again. But notice the CCI is still dropping, still in a decline. So at some point, we are going to see a pullback. Can't really tell it at this point where it's going to when it's going to start pulling back. This came close to pulling back. You could have actually done a smaller divergence in that range there. Let's see if that worked from that high. See if we pulled it back to those peaks there, down to that low, and we took it back to that low there, that significant low. You can see there it touched that 23-38% range in that little range there. So if we had extended that, that would have been hit at that point. That's why I don't trade these divergences. I just look at them as a potential exit area. If I'm going long, possibly you would have exited at that point once the price dropped below the moving averages, and then readjust. And as soon as that started bending up again, at that point, you would have entered another long position at that point. Although it's a bit of a gamble there, because even though the CCI is starting to rise, it's still a bearish divergence longer term there. Now looking at the back test, what I've done here on the daily, we've got the going long from that point on the 21st of May. And this is the hourly back test. So starting from around about there, I've started it right back at this point, but you can see where if you started it there would have been ideal. You've had a few little trades entered there, a couple of drawdowns, and this was a major drawdown at that point when the price started pulling back below that moving average range. And what does that tell you? You'll notice as well we had a bearish divergence here on the CCI versus higher highs in the price. There was a bearish divergence, plus the price started breaking below that moving average range, and that's where you should have closed out your position. Maybe holding one contract open, you should have closed it out, and that would have avoided that drawdown. Wait for the price to start readjusting. Notice here we had a bullish divergence, and you probably would have started entering a position there. This way it kept going sideways. And at that point, it was no longer a divergence. So at that point, it was a divergence. It hit our little target area. Then it started readjusting along with the price. And that's where you would have started entering long trades from there. So this is silver. First off, on the weekly, the price is very much above the moving average, similar to gold. Again, we've got a bearish divergence here. If I just adjust those slightly, those peaks on the CCI are still declining versus the peaks on the price. So that's a bearish divergence. And currently, there's no sign of a pullback. So don't go placing short trades, of course. We wait for a confirmation with our trends. On the daily, now we had this resistance up here at 39.53. And currently, we've got a new resistance up there on that peak there at 41.68, and that's possibly going to start pulling back. Again, notice here on the daily we've got a bearish divergence still, and that goes to that would go to that high there. So if that started pulling back there with that resistance we've identified, we're going to expect a pullback. Let's take it back to that low there. We take it back to the significant low there before the divergence started, and we're looking at a minimum retrace to that level there. Now it could go a lot further, as I said, we don't know, but at this point that's a bearish divergence on the daily. Of course this could go higher, the price could go higher. Again, I don't trade these, I look at them as areas to get out of long positions. In this case, if I was holding silver, I'd probably take my profits with this resistance and bearish divergence in play. Looking at the hourly for any micro moves, again you can see there we had another bearish divergence before our last video. That's extended, and since then it moved sideways and it's extended even further to that resistance, as I said. So we take it to that level. That's still a bearish divergence. And again, looking at this one on the hourly, from that high, you could probably take it back to that low. That closely corresponds with the daily as well, in terms of a 23-38% Fibonacci range. So that's the hourly, so get ready for a bit of a pullback, most likely. And if we go to the back test, now this is a good example to show you what to look out for. I've got here on the daily going long from about the 19th of May. So from that point there, you would have taken long trades. But notice, always pay attention to divergence. We had a couple of bearish divergence back here. Okay, they pulled back. And this one here was a major one, showing a bearish divergence, and you should have got out of the long positions at that point there. And what happened since then? The price dropped quite strongly, and that had a massive drawdown and used up all your capital if you were trading and holding on to those positions. So even though you're averaging down, you want to make sure you close out and maximize your returns, and pay attention to the divergence on both the daily and the hourly charts. Make sure you hit that like and subscribe button to support the channel, and if you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.